To cut to the chase and to paragraph one, are we re-seeing now a new commodity supercycle?
Hey, Tom, thank you for having me. I do think we are seeing definitely upside pressures. And in some cases, across the commodity complex, we could see super cycle-like behavior. But I do think it's going to be more concentrated on the metals. Unfortunately, I don't see that cycle happening in oil. I do see upside pressure on oil prices, but as you know, oil is the main commodity, is the largest portion of the commodity market value. So, and it's going to be hard for oil to see the kind of super cycle we witnessed in the 2000s.
Off the metals, then, how do you apply capital on a bet of the Pacific Rim? Is it as simple as buying renminbi? Is there something more nuanced if you believe in a metals play?
No, I mean, I think you can buy industrial metals for sure. You know, we do like copper a lot. We also like nickel, although we think it's a little stretched right now. We think aluminum will perform well. And then, of course, there is also some of the precious metals that are used in new technologies like silver or platinum, palladium. So we like those metals and think those have still significant upside over the course of the next few years. But you know, that's kind of the most direct way to do it. And then, of course, there is also the equities in that space, which I think are also interesting ways to lever into the metal story.
Allow me to jump in,
really
Francisco.
About energy, yeah.
Yeah,
sure.
I need to bring in the China conversation as well. What's your read on what's happening with China right now? And can you be this constructive on metals, on the miners, when the recovery in China is really maturing at this stage and not accelerating?
I think you can, because remember, the metals are not just about China. It is true that half of the world's metals demand comes from China. But what we're going to see in the next few years is a huge transformation towards the electrification of transportation, the electrification of industry, and also the decarbonization of electricity networks. And those three elements are very, very metals intensive. So in my mind, metals still have, I think, quite a run ahead. Energy is probably going to run too. And remember, as those vaccines get more and more distributed, and we heard from President Biden yesterday that we may have vaccines for the entire population by May in the U.S. Johnson & Johnson is going to really accelerate the vaccination process with their vaccine. That could also lead to a pickup in mobility around the world. But the thing is, we have 10 million barrels a day of spare capacity, 10% of supplies still spare in the case of transportation fuels. So that's going to, I think, lead to OPEC tomorrow opening up the taps and tempering the price appreciation. But you'll still see, I think, the commodity cycle moving higher, with particularly with all the monetary and fiscal stimulus that we've seen so far.
Well, let's get to some numbers this morning. Brent 63.93, WTI 60.88. Francisco, where do you see this topping out? What are the limits of this rally?
So we think for this year, the limit is about $70 a barrel. So we don't see a lot of upside. And we think that OPEC is going to be quite careful, trying not to breach that $70 level on Brent, because obviously that could trigger a fair amount of response in the U.S. shale patch if they did. So I do realize producers are trying to be disciplined, but obviously there's something called price that can change the
Francisco, actually, can you elaborate on that, this idea of the price point at which shale comes back into the picture?
Right. Well, so remember, the curve is in very steep backwardation. So the spot price is very high relative to the forward. If you look at prices for oil 5 years out on WTI, they're actually under $50 a barrel. So what we think is OPEC wants to keep the curve in backwardation. That's definitely a key objective of the group. They want to collect a high price on a spot basis and give shale players the lowest possible price on a forward basis. And again, this means that they'll try to keep things relatively tight. But I do see eventually over the next 3 years, there's a risk, as I mentioned earlier, if demand accelerates beyond our expectations. And remember, the next 3 years are going to be the fastest 3 years of oil demand growth since the 70s, simply because we're coming from a very low base. But if we overshoot, that's where I think the upside risk over the next 3 years could be up to $100 per barrel. So that's our view, that we could see up to 100 if demand conditions really stand up to this level, so of 9+ million barrels a day.
Francisco, can you talk a little bit about the dynamics of what that would look like, that upside surprise, in terms of both GDP growth, in terms of the recovery in international travel? What would we have to see to get to that $100 a barrel?
So I think, as I said, from an oil demand standpoint, we would have to see over 9 million barrels a day of growth. We would have to be above 2019 levels from a demand standpoint by the second half of next year. So again, relatively quick acceleration. And we will also, that's from a oil consumption standpoint. From a GDP standpoint, again, our U.S. economics team is calling for U.S. GDP of 6.5% this year. Some of this spills into next year with growth potential in the 3 to 4% range. So if that's the case for the U.S., the world follows along. We see a relatively weak dollar on the back of that because some of this U.S. growth feeds into international demand for goods, as we've seen so far, and that feeds into a stronger Chinese balance of payments. Together with EC monetary policy, all of that can actually trigger us to that higher level from a macro standpoint. So it's those three things, really. It's improving micro fundamentals, it's continued EC fiscal and monetary, and it's, of course, continued improvements in China's balance of payments. Those are the three key elements for a continued commodity rally.
Francisco, just a final question from me, just to wrap things up on the metals market. How supply responds there? Because they've been disciplined over the last few years because they got burned coming out of 2011, 2012. Do they maintain that discipline? Do you see them doing that, this story of value over volume that really started with Rio and BHP several years back?
I think they do. I think they do. And in fact, I think what the metals, I mean, ultimately, remember, one thing is very different in the metals versus energy is metals don't have something like U.S. shale. U.S. shale is short cycle. It can respond within 6 to 12 months. Nothing in the metals world responds in 6 to 12 months. These are very, very long investment cycles. You're looking at 7, 10 years. So even if they responded, they'll still probably respond by the end of the decade. And by then, we will have maybe 20, 30% of vehicles being sold into the market will be electric. And that's going to create some serious bottlenecks in the metal space, in our view.